December, after a blistering record run, silver has now hit reverse. The white metal pulled back sharply after surging past $80 an ounce for the very first time as traders booked profits following a record-breaking rally driven by a tight supply-demand imbalance. Silver fell as much as 5% on Monday after briefly hitting a fresh high of $84 an ounce, following 5 straight sessions of gains. Now, silver's sharp rise capped a years-long rally in precious metals fueled by heavy central bank buying, strong inflows into exchange-traded funds, and 3 consecutive interest rate cuts by the U.S. Federal Reserve. Lower interest rates tend to support commodities like gold and silver, which do not offer yields, with markets now betting on further rate cuts in 2026. Analysts say silver has outperformed gold partly because of its thinner market. Unlike gold, which is backed by deep liquidity in London's bullion market, silver has limited inventories, making prices more volatile. Technical indicators now suggest the rally may have gone too far too fast. Silver's 14-day relative strength index climbed close to 80, well above the 70 levels that signals an overbought market. And India's foreign exchange reserves rose sharply by $4.4 billion to as high as $693 billion in the week ended December 19th. This as per the latest data released by the Reserve Bank of India. The increase was largely driven by strong rise in gold reserves, which jumped $2.6 billion to $110.4 billion during the week. In the previous week, the overall Forex kitty had grown by a more modest $1.7 billion to as much as $689 billion. Foreign currency assets, the biggest component of the reserves, increased by $1.6 billion to $559 billion, according to the RBI's weekly statistical supplement. Now, these assets reflect valuation changes due to movements in non-US currencies such as the euro, pound, as well as the Japanese yen. India's reserve position with the International Monetary Fund rose by as much as $95 million to now as high as $4.8 billion. Now, gold prices, remember, have remained on an upward trend in recent months amid highlighted and heightened global uncertainty and strong investment demand, boosting the value of India's gold reserves. After its latest monetary policy review, the RBI said India's forex reserves were sufficient to cover more than 11 months of merchandise imports, underscoring the resilience of the country's external sector. The central bank also noted that India remains well-positioned to meet its external financing needs. Now, India added around $58 billion to its forex reserves in 2023 after a cumulative decline of $71 billion in 2022. Now, in 2024, reserves rose by just over $20 billion, while so far in this year, until December 19th of 2025, the forex kitty has grown by an estimated $47 to $48 billion. Now, remember, forex exchange reserves are assets held by the country's central bank, in India's case, the Reserve Bank of India, mainly in reserve currencies such as the US dollar, along with holdings in the euro, Japanese yen, pound sterling, as well as gold. And Indian stock markets have witnessed the worst ever outflows from foreign portfolio investors as well as foreign institutional investors. Now, in 2025, this has been a trend as the sentiment towards Asia's third largest economy, that's India, remained fragile, even though corporate earnings and domestic consumption showed signs of recovery, at least as far as India's fundamentals and macroeconomics go. As of December 27th, FPIs had sold as much as 22,130 crore rupees worth of Indian equities through exchanges, extending their selling streak to a 6th consecutive month. Now, this has taken cumulative secondary market outflows to almost 240,000 crore rupees. In contrast, FPIs remain net buyers in the primary market, pumping in as much as 73,583 crore rupees during the year. Now, including these inflows, total net outflows for the calendar year 2025 stands at 1,58,407 crore rupees. And remember, we still have another 2 or 3 trading days left. Now, this has made India and 2025 in India the worst annual outflow on record. Now, out of the last 12 months, FPIs were net buyers in only 4 months, that's March, April, May and June. Earlier in the year, India was among the first major markets to rebound after US President Donald Trump announced global tariffs on the 2nd of April, attracting investors who saw the country as a safe haven amid trade tensions. However, both countries did not finalize a trade deal despite multiple rounds of negotiations. Now, adding to the foreign investor woes, Indian rupee has lost over 5% of its value this year, making it the worst performer among its Asian peers. A weak rupee directly reduces the dollar value of FPI investments and raises perceived risks, prompting foreign investors to withdraw capital in search of safer and more stable returns.